All right. Hello, everybody. Nice to see you guys again on today's Traders Talk. All right, today we have the second show of the year. And we have actually started the year with a bang, and not only with a bang, but there are also a lot of boom. Market has exploded on the first day of trading, and if you have been on the market for the past few days or the past week, it has been quite a volatile ride. Yeah, just as we start the year, it is actually already very volatile. Yeah, so we carried on. The volatility from last year. In fact, the volatility for this year is even more. Even more. In what I mean, even more is that it is even shorter. Yeah. So welcome. For those who have actually just joined us, welcome to Traders Talk, and this is the show where we will actually share with you our trading insights, and we basically do a lot of training for people who aspire to learn how to trade the stock market. Yeah, trade the stock market using options in particular, and especially trading on the US stock market. So if you are a person who would like to actually start to take up trading, yeah, then this is the show for you. And of course, if you are already trading the stock market, then this is also the show for you to actually start to learn a lot of things and get first-hand insight about how we at My Style Work trade, what type of style which we use, and of course, what our motto is actually train, trade, and thrive. Yeah, so that is from us, My Style Work. And of course, this year we have actually started with quite a number of new things on our network. And of course, if you follow us, then you know that we also issue a weekly newsletter. We also issue a weekly newsletter, and of course, we cover more contents also in our weekly newsletter, where our students can actually get access to this newsletter for free. Yeah, so for free, and there are also tons of things to learn from this newsletter itself. So great way to kickstart. And of course, the other thing is, if you also notice, we have also started to try out new things. And if you can see what I'm wearing today, it is actually some new merchandise which we are trying to launch, and of course to benefit those who are actually interested to follow our network. So tons of things this year which we have actually lined up for all you guys. Yeah, so great. Okay, so if you can actually hear me, there are some echoes here. Let me just off this sound. Okay, so grateful for those who have just started to join, and of course, if you want your friends to also catch on to our Traders Talk, and of course, today we will share with you an exciting topic. Not really. I mean, it is actually an important topic. Yeah. Today's topic is, of course, on a more serious note. Basically, we because of the market volatility, we thought of actually sharing with you guys how to actually go through this kind of volatility in the market. Yeah, without causing big harm to your trading account. Yeah, because of course, if the market is volatile, and if you don't take care of the way you trade, then of course you may get into risk of losing a lot of money. In fact, I hear that just the start of this year, they have actually been people who have already lost quite a lot of money within the first week of the year, and especially the past few days where the market has been going down, or even intraday, with more than 1% movement per day. Even if you're talking about Nasdaq, the intraday movement or the daily movement is even more volatile. They can actually go up to 2% a day. Of course, this can cause a lot of harm to your trading account if you don't manage it properly. So today we are just going to cover some important topics or some things which you guys need to take care of to actually manage volatility, to manage your account in a volatile market. Yep. All right. So let's put this in. Okay, we talk about just a little bit of what has actually happened in the past week, right? If you can see, even yesterday itself, the market has actually gapped down from opening. Yeah, if you can look here, the opening was about the closing. The closing on Friday was about 4676, and of course the market opened gapping down to 4646. Yeah. And of course, throughout the early part of the trading day, the market has actually dropped by almost 95 points. The S&P 500, right, from closing of Friday, all the way down here is actually about 95 points or 2% move. So 2% move single day for the S&P 500 is not so common nowadays. In the past year, yes, it dropped, but of course the drop is actually gradual. Within 3 or 4 days or a week, it can actually drop by 2% or more. On average, basically the drop is about 5% for each retracement in the last year. So of course, this time round, we see bigger volatility. If you can see, this is actually a 15-minute chart, right? Within the first, this is 1 hour. Yeah, within the first 1 hour of when on the market open, the S&P 500 index actually dropped by 2%. That's actually a huge drop, and of course, it will scare a lot of people. In the market, and of course, if you are long in the market, means that you are buying stocks or you're trading stocks on the long side, then of course this will cause quite a lot of damage to your portfolio, especially if you are trading nowadays on the tech sector. Tech sector, as you guys know, has been the biggest casualty in the past week. Mainly because of the expectation of the oncoming interest rate hike. And if you guys have followed our previous Traders Talk, we have also covered one session where we talk about what are the stocks which will be impacted when the interest rate in the US is going to increase. Yeah, it's going to increase, and of course, the bigger sector which will be impacted by this is the tech sector. And of course, on the tech sector side, there are also a lot of growth companies which may borrow money to grow or grow. Okay, of course, that will cause higher cost of doing business or cost of borrowing, which will impact their bottom line. Yeah, so this is actually one impact. And of course, the other one is the interest rate, of course, will also impact valuations because the rates are actually used to compute the discount factor in determining the valuation of the companies. And of course, when interest rates goes up, then the valuation will come down. Yeah, so that can be seen, of course, on a lot of growth companies, especially those which do not have so much profits. Yeah, in the last 2 years, basically, you see that a lot of these companies' valuation or stock price has actually gone up. But in the past 6 months, you will see that a lot of the 2020 so-called top growth stocks has actually done a lot of retracements in the market. A lot of retracement already happened in the past 3 to 6 months, and of course the current year, the impact is actually still continuing because the time for the actual interest rate hike to be implemented is nearing. And of course there are, also meetings today I think there is actually a Senate hearing where Jay Powell would be present, and of course Jay Powell, being the Fed chairman, would also start to speak about tapering, the bond purchases, that they will actually run down, and of course the other things which he will also speak on is of course no other than the interest rate decisions or the implementation of the rate hikes in 2022. So a lot of things happening this week. End of the week, Friday, there is actually also going to be this retail report coming out for December, and of course December being the Christmas shopping season, then of course we expect this to be impacting also the retail sector, and of course the bigger companies which will be people will be looking at is actually also on Amazon. This is actually Amazon, right? And because of the market volatility, you can also see that Amazon has also retraced by quite a lot, by about 16 or 17% from the highs in November. About 16-17%. Of course, this also provides us traders an opportunity to trade the market. And the other thing which actually happened yesterday was that, as I said, in the first 1 hour of the market, right, the S&P 500 has actually dropped by 95 points. Because the drop was so big, by 11:30 I already went to sleep. Because I got no IC, you see, no IC, because everything is red, right? So of course I went off to bed early, about 11:30 or before 12. I already knocked off and slept. And of course in the morning when actually I woke up about 2 something. I think I woke up about 2 something, just had a look at my portfolio. I just saw that the positions before I slept till 2 a.m. has actually improved. Still in the red, improved, but still in the red. Then I continued to sleep. But when I woke up, to my surprise, the S&P actually closed positive 27 points. So you can see that how volatile the market can be. At one time, it can actually go down by 2%. And on the other side, just before you know it, while you are sleeping, then of course the market has quickly rebounded up to close 27 points higher than the open. So this is market volatility, and of course depending on depending on how you see the market going, whether it will continue to go down or whether it will rebounds up, then of course you can find opportunities. In fact, yesterday before I slept, I just put on some positions of badly hit stocks. One of it is UNH, right? UNH, United Health Group. United Health Group, where let's see, where before I slept, I think it was more or less no movement. Yeah, I think it was more or less no movement before I slept. But of course, when I saw the market coming down so hard, right, then of course, this is actually one sector where I want to how to say, hedge my positions into healthcare. I will also show you later on why some of these things which we are doing to actually manage our portfolio. Yeah, so I'll show you later on some things which we can actually do to manage volatility. Yeah, so this was one thing which we did. Yeah, and of course, Nasdaq has also gone down yesterday from opening till about the first hour, right? So it has actually gone down by quite a lot also. Where was it? It was actually, this is daily. Yeah, you can see that on opening it was here. Yeah, so 15380 on open. It all went down all the way to 15168, and then it actually closed above by 22 points, about 22 points. Again, similar things to the S&P 500. Open gap down and then close higher, and from the high in November, in end of December, right, after the Santa Claus rally, the Nasdaq has actually dropped to a low of about 8%. Okay, so again, basically, these are actually similar trends, right? If you have actually noticed, these are actually similar trends to last year. Okay, last year. Okay, as we said in our show last week, right? Basically, last year we have actually seen about eight retracements, about 10 retracements. Yeah, last year we have actually seen about 10 retracement in the market, and of the 10 retracement for S&P 500, right? The average retracement comes to about 5% each time. Yeah, each retracement basically it is actually about 5%. Okay, and uh, and for and for Nasdaq is actually higher, and of course, coming back here. For S&P 500, the current retracement, right, has already come to about 5% before the reversal yesterday itself. That means from the high in the first day of the year, right? First day of the year, it achieved all-time high. It has retraced all the way down here already by 5%. By 5%. Yeah. Again, that is actually the historical average for S&P 500 retracement. And I'm not sure if the market is actually looking again at this so-called 5% historical data to actually capture uh, the so-called lowest retracement point that S&P can go. And of course, once it hits this 5%, possibly there are a lot of deep buyers to come in and actually buy into the market, and probably because of that it has went up. I'm not sure. Yeah, but we can continue to monitor the trends, because at the end of the day, all these trends in the that means the trends are, this is what we call market trends and patterns, which can actually repeat itself in the market. So this is actually something for us to watch at also. And of course, on the other side, for Nasdaq also, basically the retracement point which we are actually looking at is also around 8% average. Yeah. Okay, so these are the things for us to continue watching. And of course, if going forward for the year, this continues to be the trend, then of course this kind of data can be very powerful for traders like you and me. Yeah. So of course, when it hits it, then there is opportunities to actually get into badly beaten down stocks and of course to actually ride the retracement, Yeah. All right. So we'll come back to the topic of today, right? Let's put the slides on. Okay. Okay, so I'm going to go through some of the points for you guys to actually catch and gauge how to actually manage your trading account, so that to reduce the impact of market volatility to your portfolio, your trading portfolio, and also at the same time get positive effect, or so also possibly balance effect, that the market retracement will not impact your account badly. Yeah. So of course, one of the things which we do always say is that trade small. Okay, what do we mean by trade small? Okay, trade small means that you don't go into big trades. That means basically, let's say for example, if you have an account of say 10,000 US dollar account, you don't go into a trade where it will take on a buying power. That means a buying power, or which can actually cause a max loss of $1,000, for example. Yeah. And of course, if you do that, then basically the trade size is already much higher, and you are actually taking on too much risk. One of the basic principle which we use on risk management is of course to actually trade your account. That means risk your account between 1 to 3% of your account as the so-called risk that you can actually take per trade. So for example, if you have an account of $10,000, right, then basically you can actually go and do any trades that has a possible risk of up to $300. Yeah. So of course, if the trade goes against you, then you will lose 3% of your trading account. Then of course you will still have 97% of the account to continue trading for the rest of the months or the rest of the year. Yeah. So this is what you call trade small. And of course, you can also enter into several trades at one time. But of course, again, based on your account size, you need to actually balance up how many trades for you to actually undertake. And of course, for an account of $10,000, because it is small, I would recommend that you build it up slowly and not actually enter into many transactions at one time. Yeah, because once the market goes against you, it can actually wipe out a lot of your trades all at one time. Yeah, then that is actually very painful. And that's where people who actually over trade their accounts will actually bust their accounts. Means that their account will actually go to a drawdown, and eventually the whole account gets to zero, or gets to zero. Yeah. So the first one is actually trade small. Yeah, trade small. And of course, the second one, which we advise traders to do, is when you trade small, then in order for you to actually generate the volume of the trades, right, then you increase your frequency. Okay, what is frequency? That means you trade small, and you increase frequency means you trade often. That means, for example, if you have an account, you enter into three trades, and then within the three trades, you can actually go in and out of the trade. That means you take profit, and then you recycle your capital, and you trade again. Yeah. So that is basically to increase the frequency, because I mean, especially if you are trading options, right? Especially if you are trading options, and if you are actually selling premium, that means you are actually collecting premium in the market. Then of course, there is already some statistic that is actually proven in the market that if you trade certain, if you get certain volume or transactions in the market, that means you will have certain kind of probability of win. For example, if you do 1,000 trades, then of course there is actually you can actually create that expectancy for you to actually get a positive return, positive return. And of course you have to follow some rules and trade small, trade often, and increase your trading frequency. So that is actually the second point to actually survive volatility. And of course, the first one, trade small, is actually in case it goes against you, the losses which you incur is small. Then the other one is the frequency, right? Okay. The other thing on the frequency is also like I said last week, right? One of the things which we have actually taken on from the market volatility is that the market is actually the market goes up and down, right? Okay. And the period of the market going up and down in the past year is actually about slightly above 1 month. That means almost every 1 month the market will actually have a retracement. Okay. And of course, when the market retracement comes in very fast, right? Then say for example, if you are in a long position, right? You're long position, then you would actually want to try to actually get out before the retracement comes. Otherwise, when you actually enter into a trade, say for example, on the 1st of January, 2nd of January, you actually enter into a trade, and the historically the retracement comes in a month. Yeah, say that you're riding on the up wave of the market together with the stock which you have long, then within 1 month, after 1 month into the trade, right, you are actually generating profit. Yeah, but of course, if you do not exit the trade, and suddenly on the after the first month, the market retracement comes, and you do not know when the market retracement will come. We do not know, and of course, once the market retracement comes, then what happens is that the profits which you have generated can be wiped out, or you can even go into losses. I mean, this is actually last year, and in fact, this year the volatility is even shorter. Within a day, right? Within a week, or even in the same day, the market can go up and down. Yeah. For example, we had a position on Facebook. It's a bull call spread where it was already $10 above the short strike of the call. Yeah, it was already $10 above the short strike of the call. So of course, if it's actually $10 above the short strike to expiry, basically it was this 21st of January expiry, and of course, I mean, even myself, I thought, okay, there is still buffer. I mean, I can still squeeze out some profits from this trade, because it was already $10 above the short call, and not knowing the after the first day of the year, right, the market started to come down. The market started to actually come down. Then of course, from $10 above the short call, it went, I think it went down to probably $10 below the long call. Below the long call. Yeah. So you can see that how fast things change. So when I say increased frequency, so whenever you have already a profit, anything above 50% is already good for you to capture and take on the profit and exit the trade and recycle your capital and wait for new opportunities. Yeah. So this is actually the second point of surviving volatility, which is increase your trade frequency. Yeah, you can actually do in and out shorter trades to take profits more often. Yeah. Okay, and the next one is actually diversified sector. Diversified sector, and as I've said earlier, right? What happened is, of course, the sector which was actually most hard hit, right? Most hard hit this last week, and also till last week, and also for the past last week was actually on the tech sector, Okay, so if you look at the this heat map, right? Okay, this heat map, you guys can actually get it from uh, Finviz. Oh, sorry, wrong one. Finviz.com, finviz.com. Finviz, finviz.com. Okay, all right. So this you can actually get it from finviz.com. Okay, so finviz.com, you can actually get this heat map. This one which I'm actually showing you is actually the weekly heat map. You can actually do the daily, monthly, 6 months. You can actually choose to see which are the sectors which has been in the red or in the green, depending on the period. Okay, so this one which I'm actually showing you is the weekly one. That means for the past 1 week, that means last week, right? Who has been in the red and who has been in the green. Okay, if you look here, they're actually the tech sector. This is actually the tech sector here. Yeah, this is the tech sector. Then this is actually the communication sector, and this is consumer cyclical, cyclical, tongue twisting. Okay, so and then of course there is financial, entertainment, healthcare. This is healthcare. What is this? Insurance, medicine. These are subsectors of the healthcare. Yeah, and then the consumer defensive, real estate, energy, industrials. Okay, so what happened in the past week? The tech sector has been hit quite badly, and of course, when the tech sector is actually hit, then of course the fund or the money will actually move to other sector. Okay, I mean it's just like if you play a game, right? If you play a game and you don't like to play this game, okay, then you will tend to go and find other games which are actually more interesting. So the stock market is actually no different than just a game. Okay, people tend to find places where it is actually more interesting for them to put their money, because at the end of the day, people want to actually gain from the stock market. Okay, and of course, when the tech sector is actually not so interesting to invest their money, right, then they will actually move to other sectors. For example, energy sector. Okay, energy sector last year, it has actually been the most profitable sector, and up till now it continues to be one of the sector where people take refuge from. Although it is actually not an interesting sector, yeah, because the energy like oil and gas and all these kind of things may not be how to say that great of a place to actually invest. But of course, companies like Exxon, right? Exxon has been actually performing great in the past year, and it continues to perform greatly good in the market. Okay, so Exxon, Chevron, and all these companies, ConocoPhillips and all, because the oil price continue to be high, then of course when the tech sector is hit, the communication sector is hit, addition people would actually move their funds over to this the sector which interests them more lah. So it is actually, one of it is actually energy, and the other one is actually industrials. Not forgetting the financials. Okay, financials is again, I think last week it was already more or less topish. This I think this week, yesterday itself, I think the XLF, the finance sector ETF has reached its all-time high, has reached its all-time high, and of course, even for us, some of the finance sector positions, like in Goldman Sachs, we have already exited the week last week, or the I think it was last week we have already exited some positions to actually capture the profits. We are still in XLF already. Also, we exited XLF. Also, last Thursday or Friday, we have also exited XLF. BAC, we also exited BAC last week. We only have one more position in Citibank. And the reason why we have not exited Citibank is because we are still making losses in the trade. Okay, so for those trades which we have already captured the profits, we have already exited. For Citibank, we can actually hold on a bit more. It is actually close. I think it's another $2 or $3 before we start to actually turn green. And hopefully, just before the coming earnings this week, we can actually exit Citibank also with a profit. So that was the sector which was quite profitable for us in the past month. Yeah, financial sector. Okay, and of course, yesterday itself, we again put in a position back in Goldman Sachs. We already again we put in a spread, a book call spread on Goldman Sachs. And of course, the reason why we actually entered is Goldman Sachs has retraced a bit from the time which we exited. It has actually retraced a bit, and of course, because also of the impending discussions and all about the interest rates. Right, today there's another one. Then of course, we are taking on again a bullish bet that the statements of the accelerated interest rate hikes will actually come in again to push the news. Actually, the news is already there. I mean, everybody knows it's actually probably coming in March. But of course, the media, right? I mean, the media likes to actually write and hype out everything. Okay, hype out everything. And of course, when this thing is hype again in the stock market, again a lot of I would say retail traders, not professional traders, will actually read the news and they start to buy into the stocks. And of course, when the retail comes in to buy, that's the time when we traders exit the trade. Okay, so that is one thing on the sector diversification. So you actually need to diversify your trades along different sectors during different time. And of course, it's not only long positions. Some we actually go long. And of course, on the tech sector, in the recent weeks, we have also started to put in bearish trades on the tech sector. Yeah, bearish trade on the tech sector. Some even 1 or 2 days we already exit the trade within 1 or 2 days. Yeah, or even the daily. On the same day itself, we go in, and then when the sell down comes, market sell down comes, that's the time where we actually exit the trade. Yeah, and all this actually happens when I sleep. All this happen when I sleep, because we enter the position, we put in a limit order in the market, and of course, if that limit order is hit, then they will actually the system will take profit for you, and while you are sleeping. So that's a great thing about trading the markets, is that you can generate income even when you are sleeping. Yeah. And of course, we on the volatility of the market, we were trying to find great trades. For example, Google, we tried to actually put in a bull put spread when it actually came down yesterday, but it did not fail. It did not fail, and of course, in the morning, from a drop of I think $50 or $60 yesterday, and on opening, Google has actually turned positive. Yeah, so this was actually the yesterday's heat map, where you can actually see from the past week, the position is like this. Until yesterday, the position has actually changed drastically, where all the tech sector has actually turned green, turned green. And then these are all the tech sectors turn green. The what is that? The financial, as I said, it has actually started to turn brown or some red here. Yeah, and of course, on the healthcare is actually still all green. That's the reason why we have actually entered onto the UNH trade yesterday. And of course, like good for us that it has now turned green, and hopefully today it will continue. And if it goes up a lot, then of course that's the time where we increase our frequency and we exit the trade. Yeah, yeah. So these are the some of the things which we are doing, and some of the pointers which we are giving you guys. Yeah, so that is the third point for the day. Yeah, to actually look at diversifying sectors, and you can long and short different sector. Short tech sector, long healthcare, long energy is fine. You don't need to actually go only on long, and that's trading options, right? I mean, you can actually trade when the market goes up, you can trade when the market goes down, you can trade even when the market don't move. Yeah. Okay. So okay, then of course the next one is actually the trade strategy. Okay, trade strategy. Okay, what is this trade strategy? And of course, if you are trading options, right? You can actually do different type of strategy according to different market conditions, according to different type of stocks and all. Yeah, so you can actually do different trade strategy, and of course, to actually balance up so-called your portfolio volatility, right? It's actually good for you to have different strategy in your portfolio. One example is, of course, you can have a mix of bullish and bearish strategy. Yeah. For example, in the past weeks, we had bearish strategy on the tech sector. Yeah, tech sector, and we had bullish strategy on the financial sector. Yeah, we have a bullish strategy on financial sector, and of course, when that happens, is that if tech sector is going down, you're making profit, right? And then of course, if the financial sector is going up, you are also making profit. But overall, the market is coming down. Overall, the market is actually coming down. Yeah. So even the market is coming down, crash by 2%, 3%. It's probably would not impact you because you are diversified in the strategy which you are using. You are also diversified in the sector which are performing against the general market. Yeah. So this is the one on trade strategy, and of course, you can also have a new other strategy like a neutral strategy. You can also have a other strategy like a neutral strategy on certain stocks which you feel that whenever there is actually an oversold position on the stock because of the market drop, eventually the stock would actually go up again. Yeah, when the so-called retracement completes and the general market goes up. Okay, so one of the sectors which we actually try to use this strategy is actually on the what is that, on the semiconductor, because generally you see that the semiconductor is actually a very a strong sector as a whole. I mean, companies like AMD, Nvidia, TSM, and then TXN, yeah. So all these are actually very strong companies, and of course their products and services are in demand. But of course, when the overall market retraces, right, they may also take a hit, because overall market retrace, some people might exit positions, and some people would actually cut loss if the price actually drops. So of course, these stocks will drop a bit alongside the market, and of course, when the market goes up, they will actually rebound. So like these kind of stocks are generally, we try to actually go in with some kind of neutral strategy. That means when it goes down, we can actually make profit on the when it goes down, and when it goes up, we actually make profit. And of course, one strategy which are neutral, which you can actually use, is iron condor. Iron condor is actually a neutral strategy, where you collect premium on the call side, you collect premium on the put side, and of course, when the price drops, you earn on the bear call spread, and of course, when the price goes up, you also earn on the bull put spread. Yep, bull put spread. And at the end of the day, you try to actually get the stocks to go back to the so-called middle position in between the bull put spread and the bear call spread. Yeah, and that is the time where you actually maximize your profits. Yeah. So again, diversify your strategy, have a view on how the stock behave, and from there try to actually adapt one strategy which basically fits how this kind of stocks behave in the market. Yeah. So that is actually a trade strategy. Yeah. So these are the few things which I wanted to actually cover today, which is to try to actually minimize volatility in your account, and how you can actually protect yourself from a volatile market, and in order for you not to lose money in your portfolio, trading the using the wrong strategy, over trade, yeah, or also what is that? Also having the so-called balance strategy, and also diversified portfolio, so that the overall market moving down will not hit your portfolio that much, and in fact, your portfolio can continue to even be profitable when the stock market retraces. Yeah. I mean, when it retraces, let's say tech sector goes down, you are bearish on tech sector, you take profit on the tech sector, and of course, once the market finishes on the tech sector, finish killing all the tech companies, right? Then definitely you will move to another sector to kill not to kill, yeah, to actually move into another sector. Yeah. So always have this kind of things, have within sectors itself, have a few of your favorite stocks to actually trade, understand their behavior, and adapt your trade strategy to the stock and also the sector. Okay. All right. So one thing to add on, one thing which we actually also covered in our newsletter, right? In our newsletter, we have actually started one. Let me see. We have actually started one section which we actually called trade watch list. Okay. And in this trade watch list, basically, we try to actually explain also what are the potential trades, right, that we are actually currently eyeing in the market, to see whether there's actually potential for us to trade. And the stock which we actually covered this week was actually Starbucks. And if you know Starbucks, I mean, Starbucks is actually a very, very great brand, and of course, during this past few months, it has actually been hit by I would say a little bad news. A little bad news. I mean, it's not is mainly some pressure on their stores with setting up of unions and all these kind of things. So some analysts starts to actually also give negative reviews or even downgrade Starbucks, and of course all these kind of things also causes volatility within the stock price. And of course, for let's say here you can see since August, right, where it has actually reached a high of about 126, right. After that, this is actually the all-time high of 126, and after that, basically, Starbucks has been trading in range, yeah. And of course, when it trade in range, it does not mean that there is actually no opportunity for us to trade Starbucks or even to long Starbucks, is it? And we had actually gone in and out of Starbucks many times, many times. And of course, when there are opportunities, we actually go in Starbucks to long our positions in Starbucks. And of course, this, as I said, many times round, we have gone long when we saw opportunities. Of course, this was one time where we actually entered, and then there was I think around this time we also entered into Starbucks. Okay, every time when Starbucks actually retraced to the level of between on the lower side of the 100, on the lower side of the 100, basically we took opportunity to enter long positions, yeah, long positions, yeah. Whether depending on what strategy, of course, this retracement was quite big gap down. Then of course, this we actually even entered a naked put much below. I think it was all the way at $100 naked put, together with a bull call spread. Together with a bull call spread, yeah. So that is one of our favorite strategy. We constantly promote this strategy, or use this strategy, in our trading portfolio, where we actually get to enter into a very cheap debit trade by using a naked put to finance the trade. And of course, here this time round, we also see an opportunity for us to actually enter into a similar kind of trade. Possibly right now, I would not do a naked put, mainly because of the market volatility at the time now is a bit uncertain. So of course, if I do a naked put, then I have to have the view that I don't mind to actually buy Starbucks at that naked put strike price. If I do not have that view to take up 100 Starbucks stock, right, then of course I would not do naked positions on Starbucks, but I will only do a long positions. A cheap entry would be via a bull call spread, and of course, the spread with I would normally take on this stock would be $5 spread with. And of course, if and yesterday itself, in fact, there was an opportunity when Starbucks dropped to about $3, dropped by $3 over. $3 over, we could have actually already entered into this trade yesterday, but we we did not do like, I mean, basically I still wanted to it to continue to actually go down below this previous low level, and actually then retraces up with a bullish green candle. Even if you see that this is actually a bullish candle, but I would prefer to have a safer trade by having a bullish green candle coming back up below this previous low level of about 104, yeah, 104. And of course, if that did not happen, today I would probably think Starbucks would already be in the green and up if the market is up, which I think market should be positive today. Today, earlier the morning, the S yeah the futures was still rate minus 4 or 5, but now it is already plus 14. In fact, early this morning, uh, we have already put in a bull call spread on ES futures at 4670, I think 4665 4670, yeah, 4670, a $5 with bull call spread, expiry next week expiry. So next week expiry, I paid about $3 for it. I paid about $3 for it, and of course, I would actually exit if the market rebounces today. And of course, if it rebounces big time, then of course I would probably just exit with a small profit between $50 to $75 profit. I would actually exit the trade. Yeah, 50 would be fine. Yeah, ES uh, is half the value. I mean, $5 with the it will be about $250, right? $250. So $50 profit would be quite good for a single one lot trade, and the return is also great. Yep. So short trades, quick in and outs in the market during volatile times. So that is Starbucks, the trade on our watch list that we actually want to do when we actually see a rebounds after it dipped down to 104. Yeah, 104. And of course, if it don't go down, right? If it don't bounce up, if it don't bounce up, then of course we can always exit the position with a small loss, when it goes down below 100, when it goes down below 100. Or you if you can, you don't mind, you can also continue to keep the trade, but of course it will show it will be negative for a while, but your max risk will be capped at between such trades, this trade probably between 150 to $200, 150 to $200. Yeah, so that's your max loss. Max gain would probably be about if $200, then your max gain would be about $300. Yeah, so risk ratio between 1 to 1.5 is a norm for us to actually do bull call spread with a $5 width. Yeah. Okay, so that is the watch list which we actually published on our newsletter this week. Hopefully we can get a new trade. We can get a new trade next week. Then of course we will continue to share it on our weekly newsletter. All right, great. So for those who are on, great for you to be with me here. And of course, if for those who had not had the time to join us live here, then of course the repeats are available on our Facebook page. You can go and watch the repeat. And of course, then if you have any questions on what I've shared today, then by all means post it on our Facebook page. And if you have any questions now, you can actually post it also here. Then I will answer you here live. And of course, if there are no answer, then we will be waiting another 2 hours, waiting 2 hours, I can have my dinner, and then another 2 hours, then I will see you together on the market opening. Yeah, market opening later in the next 2 hours. Okay, so until then, it has been great again with you for the start of the year, and on our Traders Talk Show. And I hope that you guys have a great trading week, and I will see you again next week. So until then, this is Meng Hon signing off from Traders Talk. So don't forget to train, trade, and try. See you. Bye bye.